Okay. So let's see how the disclosures are made before we launch this, before we actually start this. Can you see this? This is my consolidated income statement, which is a requirement. I'm looking at Coca-Cola. And here, can you see what's we're doing? We are having basic income per share. Then we are having diluted income per share. And on the face, they're letting you know what is your average share outstanding, average shares outstanding, what was the effect of the dilutive shares, and what is the average shares outstanding for the diluted portion. So typically, we are letting you know what is my, so here, assuming there is no discontinued operation, otherwise it would have shown separately. When there are no discontinued operations, you get net income, basic and diluted per share, and you also get an idea of what is the weighted average number of shares on the face of the income statement itself. And then there will be some calculations that we're going to see. Okay. Now with this, let's start the topic today. Okay. So what we're going to discuss in today's session is we're going to talk about certain concepts. We are going to talk about what, this is only earnings per share, guys. Okay. Okay. So what we're going to talk about is first, what is EPS? This we've already discussed, right? What is EPS? It is profitability, the current profitability of the company with respect to the ownership. That means how many people are owning the company and each one of them. So each share which they have, which has the control over the company, for each share, what was the profit that the company generated and could have given you in the current year. Whether they gave it to you or not is immaterial. So if I say that my EPS is $5, it simply means that $5 could have been paid on an average each share of the common stock outstanding during the year. That means understand that there's a difference between issued capital and authorized capital and outstanding. What's the difference between issued and outstanding? Any difference between the two? What is the delta? Quick. What is the delta, guys? Between issued versus outstanding. Is it the same? Do we give dividends on the issued or on the outstanding? What is the delta? Yes? Not same. Yeah. So typically the delta is the treasury stock. The shares that we bought back and we have not abandoned those shares, we have not written off those shares. So those shares will be company shares which are in company's hands. So we are not going to pay dividends on those shares. So outstanding typically means the shares which were issued and still in possession of the shareholders, not in the possession of the company. So out of the current earnings of the company, yes, we pay dividends on outstanding shares. Out of the current earnings of the company, if every shareholder was distributed the equal amount, what would be the amount that each shareholder would have got? That is what is meant by the term earnings per share. Okay, so why do we calculate this? Why do you think that the earnings per share needs to be calculated? Why? Because it is a mandatory disclosure for all the public companies. And where do you show this? You show it on the face. You saw it, right? We saw it on the main face of the income statement. For a company which has a simple capital structure. So we'll understand what is the difference between simple and complex. But simple typically means that I have only one class of shares which is outstanding. There is no potentially convertible equity shares. That means there is no possibility that in future there are some debentures or preference shares or warrants or options that can be converted to equity shares. So if you have a very simple capital structure, I will simply report the basic EPS. But if my capital structure is complex, that means I have something called PCS, potential convertible shares. In those cases, I have to report both basic and diluted EPS. Now, guys, I want you to tell me, why do you think there is a necessity to report diluted EPS? Why do we want this? Any idea? Why suddenly nobody is a fool, right? That we have to give up a requirement, a mandatory requirement for enclosing the diluted earnings per share. What is the logic behind it? Can anybody tell me? What is the logic behind including the diluted EPS disclosure in the books? Any idea? Anybody? Just raise your hands, I'll unmute you. Raise your hand, I'll unmute you. Any idea? What was the necessity? If I don't show the diluted EPS, what's the delta? If I show the diluted EPS, what is the delta? Any idea? Yes, company may issue convertible shares. Then what is to the shareholder then? I have a basic EPS. I know what was the earnings. What is the necessity of giving you a diluted EPS? Yes. See, look at this scenario, guys. Okay. Let's say today I give you earnings per share of 20. And that is a disclosure that the company gives you. And this is my basic earnings per share. Let's say there was only one earnings per share and I gave you this. Now, 31st December, I closed my company's books. Okay. On that day, there were 100 shares which were outstanding, which were common share. And there were 100 debentures which could have been converted to 100 shares. Can you understand? 31st December, I had 100 shares in my books, which were equity shares, and my basic EPS was 20. That means my total earnings was $2,000. Yes or no? My EPS was 20. I had 100 shares outstanding, which was the common shareholders. And I came up and said, yes, my total earnings was 2,000. 31st December, I had some convertible debentures. Each of those debentures could be converted to one equity share. Now, suddenly what happened? 31st December, I told my shareholders, see, your earnings per share is 20. On 1st of January, these debenture holders exercised their option for conversion. Now, what happened? Suddenly, with the same earnings, which was $2,000, suddenly, now you have, instead of 100 shares, you have 200 shares. That means suddenly my EPS fell down to 10 without any new thing happening in the company. Have you understood what's happening? In one day, just because of the debenture holders exercising their conversion, right? What happened? Suddenly, the same EPS became half. That means now you understand that EPS is linked to the PE multiple. PE multiple is a very important multiple. Why? Because it gives you an idea of how is your share performing vis-a-vis your peers. Suddenly, with nothing that the company did extra, on the same earnings, the earnings per share of the equity shareholders became half. And that point of time, shareholders had no option because they didn't have anything in their hand, right? Because the market price will also get affected accordingly. Now, to avoid this, to avoid a scenario where the earnings will suddenly get reflected, yes, because suddenly your PE multiple will get affected, right? Your price by earnings will get affected. So what happened? With no information, if this information is not getting to the shareholders, they cannot make a timely decision about what they want to do, whether they want to still get invested in the company or not. Hence, it became mandatory that if there is a potential conversion that is happening, please assume that that conversion would have happened on the first day of the year and let the shareholders know what can be the potential effect of this conversion. The term dilution is something like, you have milk and you put water in milk and we say that now you have a diluted milk. Have acid, now you put water in the acid, it becomes diluted acid. So what we say, is there a potential dilution that you are expecting out of earnings per share? Why? Because it's a very big yardstick by which the investors judge the performance of the share. Why? Because this is linked to P multiple, and P multiples, people will have a look with vis-a-vis the peers. So we said that it's very, very important that because this is something that the shareholders would not know. So I would want you to let the shareholders know timely. So every year when you disclose the basic earnings per share, you also let the people know what can be the potential dilution. So remember, when I say dilution, I'm referring to the lowest possible EPS that can be potentially there if everything that is convertible in your balance sheet actually gets converted. So it is a what if scenario. What if all the dilution happens? How low can your EPS go to? And we're very specific. We want the lowest possible figure to be disclosed on the face of the income statement, both for your net income and your continuing operations. Is this clear? Everybody, is the logic clear? See, if the whys are very clear, no, then if you know why this thing is important, then the how is very easy. How we can really layer up. Okay, so that is why the calculation started happening. Okay, now how do we going to calculate? The how is easy. I'll just give you a formula. There's a formula for basic EPS. There's a formula for diluted EPS. The complication happens when you have more than one conversion that is due. In that case, what can you potentially do? That is what the question is. Okay. Now, thankfully, that's not too tested on CPA, but I am going to layer it up and make you reach that level so that in case if there is a question, you would be able to answer it. Okay, so we're going to talk about this. And very importantly, there are some income statement disclosures. But then these disclosures for everybody who is following any whatever books you're following, please be careful for any disclosure standard, related party, EPS, segment reporting. Just be mindful of the disclosures. You don't have to read it a lot, but I would want you to check a couple of balance sheets and P&L and notes just to see how the disclosure is happening, because that is something that will be retained in your mind. Okay. So what is a simple capital structure? Simple capital structure means there's nothing that can be potentially convertible to shares. So what is simple capital structure? We have only one class of share, which is the common shares, on which the voting rights are there. Now, in the US, you have shares with differential voting rights. I can have class A. So you will see it's very common in US to have class A, class B shares. Why? Because we have a startup bug that started earlier in the US than in any other countries that we are aware of. So what happens? People are very careful about the dilution of their voting rights, the control. So you have some equity shares where the dilution is possible. There are some equity shares where the dilution is not possible. Why? Because I issue shares. That means I have a feature that you will be paid only when the company earns, but I don't give you voting rights. There is a possibility where you have reduced voting rights for certain other class of shares. But not shares, we have only one class, we have only one kind, which is the common stock. You can also have preferred stock, by the way, okay? But what we're referring to is we don't have anything which is potentially convertible into shares. So there are no securities that can become common stock in future, no potential. So typically what we are saying is we have no potentially convertible securities, which can be converted to common shares. So what do you report? This we've already said. What we are going to report is basic, actually, and diluted. So when I go to the diluted EPS, it will be basic and diluted EPS for what? Now, this is something that is important. Please report it both for income from continuing operations, income from net income. That means the delta is discontinued operations, where on the face of the income statement. If you do have a discontinued operations, then what do you do? If you do have a discontinued operation, then the basic and the diluted EPS are reported either on the face or in the notes. But if there are no discontinued operations, then income from continuing operations become equal to your net income. So there is only one that we saw in Coca-Cola's case. There is only one EPS that gets disclosed, basic, diluted, but only for one figure, which is net income. Why? Because net income is equal to income from continuing operations. How do you calculate it? So there are two figures. The first figure is profits available for equity shareholders. Okay. So what is the profit that is available to equity shareholders? Do I get this figure as a ready-made figure from the income statement? Yes, no, guys. If I look at the income statement, do I get a ready-made figure for profits available to equity shareholders from the income statement? What do you say? Yes, no. Guys, you give me a dead class, I'll become dead. Then my interaction will be that low, if you guys don't interact. And if I go into a monologue mode, it's not going to be good for you guys. I'm repeating my question. The profits which are available for equity shareholders, that goes to determine the earnings per share. Do you get that from one figure which is there in your net income statement? I look at the income statement, I pick up a figure and I put that and I divide it by weighted average number of shares and I get the EPS. Does that happen? Do you get the straight figure from your income statement? Yes, no. What is a delta? What is a delta? There is some delta, right? Otherwise, the net income figure I'm getting from the income statement and I would have used that figure. So what is a delta? So it is actually net income minus your preferred dividends. So if you have preference shares, then those shares will have to be first paid and then the balance has to be distributed to your equity shareholders. So I take the balance that is available for distribution to the equity shareholders and you divide it by weighted average number of shares. That means if there are no preferred stock, if there is only one stock which is a common stock, in that case, the net income figure you can directly get from your income statement. But if there are preferred dividends, in that case, you will have to first deduct it in order to arrive at the figure for profits available for equity shareholders. A quick question. Why do you think we need to have a weighted average of the shares? Why can I not take just the closing share and take it? Any idea? I have a closing number of outstanding shares, right? I can just take that and I can use it as a denominator. Why are we calculating the weighted average number of shares and then I'm taking this in the denominator? Why are we doing that? Yes, any idea? No idea. Think. Bhavna, this must be very logical. See, what is this figure telling you? Is it a period figure or a point figure? Net income is a period figure. When you do ratios, you will see that ratios, when you do, you will see you cannot compare a net income figure with a balance sheet figure, right? Because balance sheet is a point figure, net income is a period figure. So what do you do in order to convert balance sheet to income statement? What do? We calculate the averages for ratios. Yes or no? We take the average for ratios. That is what we are trying to do. We are trying to make a balance sheet and a income statement figures compatible. So what do? We take the net income throughout the period and then we take, okay, on an average, how many shares were outstanding throughout the year? So we are averaging out the shares that were issued at various points. There might be a buyback, there might be a share issue. You average that out and say, okay, on an average, how many number of shares were outstanding throughout the year that corresponds to the same figure as the numerator. That's the reason why averaging happens. Is this clear? Is the logic clear? If the logic is clear, then the how is easy, right? You take the net income figure, which is the throughout the year figure, it's a period figure. You can't compare it with a point figure. So you're converting a point figure to a period figure and making it comparable. Is this clear to everybody? So how we do it? We'll just layer it up. Because here the only problem is what happens if the preferred dividends are cumulative and if the preferred dividends are non-cumulative. Okay, so that is the complexity. We'll just talk about it. And how do you calculate weighted average number of shares? Now, what is the complexity in this issue? The complexity in this issue is very clear. The problem happens if there is a share split. The problem happens when I declare a bonus share. So whenever there is a bonus issue, we call it stock dividends in the US. So I'm giving you dividend in the form of extra shares of the company. So whenever there's a stock split or a stock bonus, how are you going to deal with it? So these are the two things that might be a complication for weighted average number of shares, because otherwise there is no complication. You just take the number of shares, you take the average time for which it is outstanding and just average it out. So if I've issued shares in April, I will just take those numbers, multiply it by 9, divide by 12, I'll get the average shares. So if it is a plain issue or a buyback, there are no problems. Problem happens when there's a share split or when there is a bonus. So how do you deal with that? So this is something that we'll crack. For preferred dividends, cumulative, non-cumulative, what happens? And for weighted average number of shares, what happens in case if there's a stock split or a stock dividend? So we'll talk about those 4 complexities. And in the end, we'll just take, so again, all of these are possible if we discuss examples. We'll just see what examples we have to cover to simplify this. So see, first we'll do basic. Once we know the concepts of basics, we'll just layer it up with the diluted EPS. That's it. So how do you calculate it? So for every step, how do we calculate? How do you calculate the profit? How do we calculate the runoff? How do you calculate the EPS? We're going to take for every situation, we're going to take a question and then we're going to solve it. So first we'll talk about what is a basic EPS, just a basic formula. How do you calculate the numerator, which is the profits available for equity shareholders? How do you calculate the denominator, which is the weighted average number of shares? And what happens if there is a stock dividend or a stock split? So we have just separated the 4 issues which can potentially be there. I've tried to give you a little difficult question because if you can handle this, then the easier ones you can definitely handle on your own. Okay, so just try to take it one by one and see it. So the first question is, how do you calculate a basic EPS? So what is the scenario giving you here? The scenario is at each year end, and so at the current year end, the entity's capital structure consisted of 1,000,000 shares of 10 par value common stock. The entity issued no new shares during the year. It had income from continuing operations and net income for the year, which was this and this respectively. You are supposed to calculate the EPS. Now see guys, have you understood what is happening here? There are three figures. There is income from continuing operations, there is discontinued operations, and there is net income. Yes or no, guys? Everybody, is this making sense? So what are we saying? We are saying this company had a continuing operations of, so if I take this figures in dollars, so I'm saying that the amount that we earned in income from continuing operations was 1275000. From net income was 11400. I think I have not. Yeah. So now tell me what was the figure for discontinued operations. So obviously there was a loss which reduced my income from continuing operations and it became net income. So what is that figure? Just this was 1275 minus 1140. So typically there was a loss of $1,35,000 from discontinued operations. Okay, and I've told you that the number of shares is $1 million. So your number of shares, which is not changing throughout the year, is $1 million. Now, do you realize, guys, the numbers don't undergo a change. The base remains the same, whatever numerator you are taking in the picture. The base will not change. So what is your earnings per share? So your basic earnings per share is going to be A divided by B. So in this case, it is 1.275. In this case, it is 0.135. And in this case, it is 1.140. Yes, no, guys? Here, so this figure and this figure has to be on the face of the income statement. If you are having a standalone, it will be only one figure. If it is a consolidated, you take a consolidated figure and show it. And this can either be on face or it can be in the notes. Is this okay, guys? So this is a basic. If I have been given, this is what will be reported at various places. Which is easy, right? Now what happens when I'm calculating the puffish? What are the possible scenarios where there can be a complication? The possible scenarios are if you have a preferred dividend and if it is accumulative versus a non-cumulative preferred stock. In that case, there can be some complication. So how are you going to deal with that? So let's see, there is another question that we have here, which tells us an entity has two classes of preferred stock. It declared a 4% dividend on its 100,000 of non-cumulative preferred stock. So how much is the preferred dividend here? So we have a preferred dividend of 4% of, so basically $4,000 preferred dividend on what? Non-cumulative preferred stock, which was declared. Can you see this? So I was under no obligation to declare the dividend because these are non-cumulative preferred stock, but the company declared dividend this year. How much? 4%, which is 4,000. The entity did not declare dividends on its $200,000 of 6% cumulative preferred stock. Undistributed dividends for the past 4 years have been accumulated on the stock. And they have given you figures for continuing operations of $1 million, discontinued loss of 150, and net income of 850. You're supposed to calculate puffish. So how much is this dividend, by the way? For this current year, it is coming to $12,000. 6% of 200,000 is 12,000. Yes or no? Now the question I want to ask you is, how much should we reduce from our net income? Yes, guys? How much should we reduce from our net income? Is it 4? Is it 16? Is it 12? Is it 12 into 4, which is 48? What is the figure that you think should be reduced? Okay, I'm giving you three figures. One is 4,000 plus 12,000, which is 16,000. Another is 4,000, but nothing, only 4,000. Third is 4,000 plus 12 into 5, because 4 years past was left and this is the current year. So 12 into 5 is 60. So 64,000. What do you think will be reduced from our net income? 64, 4 or 60? Just answer it, guys. Everybody. Okay. Others, I want the answer from everybody. How much should be reduced from your numerator in order to arrive at puffish? Please do not fear being wrong, guys. Okay. Just don't fear being wrong. Okay. But we have not declared this dividend. I also understand that. But we have not declared this dividend. This dividend we declared. This dividend we did not declare. Okay. Let's see how it goes. Now see, guys, whenever there is a preferred dividend, there are two possibilities. If it is non-cumulative, now see, the 4% was coming at 4,000, right? What if I declared only 2,000 dividend for non-cumulative share? Then will your answer change? Yes, guys, that is another question, right? I was supposed to pay them 4,000. I did not have enough money. I just declared 2,000 dividend. Then what will happen? Will I reduce 2,000 or 4,000? What do you say? So there are certain rules. What is the rule? There's a logic. What is the logic? The logic is, if the shares are non-cumulative, you will reduce only that which has been declared in the current year. Is this clear? If the shares are non-cumulative, reduce only the dividends declared. Whatever is the dividend declared, reduce it. If it is higher, include it. If it is lower, include it, reduce it. If it is same, reduce. Whatever, the dollar figure is immaterial. Whatever dividends you are declaring on the non-cumulative preferred stock, once the dividend is declared, then it is out of your hand. You have to pay that. So only the amount that is declared, that figure will reduce your net income or your income from continuing operations to arrive at your profit. If the preferred dividends are cumulative, then I'm not going to wait for you to declare that dividend. So I don't care whether the dividends are declared. I don't care whether dividends are paid or not paid. I'm only bothered about one thing. What is the yearly dividend that should have been paid to them? That means when I am calculating my EPS, I simply take 1 year's cumulative preferred 1 year, because every year we will keep on accumulating. Whether we are paying it or not paying it is immaterial. Whether we are declaring it or not declaring it is immaterial. 1 year's preferred dividends on the cumulative preferred stock, I will reduce every year from my net income. Even if it increases the loss, I will still increase the loss by this amount of dividend. Is this clear to everybody? So whether they have not paid it for 4 years, 10 years, 20 years, it is immaterial to me. Whether they have paid the 4 entire years this year, immaterial to me. Every year, I will just keep on the accrual concept. I will just keep on reducing that figure by, in my example, $12,000. Is this clear? We will sum this up. But as of now, one second. But as of now, when I'm doing this sum, pay close attention to these examples. Why? Because there are a couple of topics which I've clubbed in every question, just to make you understand what is the concept, right? So here what we're doing, now we know that there are two figures that is mandatory for us to disclose. One is income from continuing operations and the other is net income. Okay, So for these two figures, we have to calculate the profit. So how do you do that? You will take the income. So what was the amount that was reported? The amount is $1 million. $1 million from income from continuing operations and $850,000 for net income. Now from here, I'm going to reduce my preferred dividends. How much preferred dividend will I reduce? I will reduce preferred dividends on non-cumulative shares, only the part which is declared, which is $4,000. Okay, so this is the declared part. And for non-cumulative and for cumulative shares, every year I will reduce the entire amount of dividends, whether declared or paid or not. Is this clear? Just give me the figure, guys. So this is yeah, 984 here. And this will be 150 less than that. That is 834. Yeah, Jashmika, do you have a question?
Ma'am, what I was about to ask is, we have not declared that I suppose like that that 4 years accumulated dividend has remained as it is, and it is going to be dispersed by 5th year. So then, why can't we take that assumption? In that, if that is
because but every year we have been accumulating it, right?
Yes, exactly. So, and then the 5th year we are going to disperse it. If we take in that assumption, then this EPS will be changing, is it?
Shankar, I'm not able to, your voice is heavily accented. I'm not able to follow you. Just go slow and tell me what is your question?
Yeah, one second. One second, ma'am.
Yeah.
Can you hear me?
Yeah, I can hear you. Just tell me what is the logic that you're telling?
My question is very simple. That if I follow, I thought in the way that we have not we have cumulative dividend which remains undistributed for 4 years.
Yes,
so in the 5th year, we are going to disperse the same entirely. If it is that, if that is the case, then we have to pay 60,000. Is it 60?
No. You cannot take that. Why? Because see, it is like saying I have cumulative. See, what is the legal requirement for cumulative shares? The legal requirement says you cannot pay any dividend to equity shareholders till the time you have not cleared the dues to your preferred shareholders who are cumulative. Yes or no?
Yes.
That is the only legal requirement, that I cannot give a penny to my equity shareholders till the time all the balances for preferred shareholders have been paid. Yes or no?
Yes.
So if the company is not paying the equity shareholders and they are not paying the preferred shareholders because the company is running into losses, or the company is really struggling, so what will the company do? The company will every year for a cumulative preferred dividend. It is like any other. It's like, say, if you take a loan from the bank, that interest on loan you have to hit your P&L every year. Yes or no?
Yes.
Whether you are increasing your losses or not, it is immaterial. That loan will go and hit.
Exactly.
So for the EPS calculation, the cumulative part of the preferred dividend, that part of dividend is like an obligation that you have to fulfill every year. Okay. Now, the year when you're going to pay all of these is a year when you're going to generate income, right?
Yes.
So just think from the P&L and the balance sheet perspective separately. The P&L will only take the hit of the amount that needs to be paid every year, because that is accrual concept. The balance sheet will take the hit of what is actually the cash flows that are happening. Is this clear?
Yes, certainly.
So this is P&L impact. The P&L will be every year 12,000 will keep on reducing before you calculate your EPS. Is this clear?
Yes.
Yeah. Vishnu, I didn't get your question. We say EPS from income from continuing operations. So if you all will, when we disclose, if the number of shares, we'll layer it up in the next question. But when I give you the number of shares, you will divide the same number for income from continuing operations and net income. So how are you going to show it? In your EPS, you're going to show it separately. Income from continuing operations, and below you will say basic. Okay, I will actually that problem, I will take out that balance sheet which has discontinued operations. I showed you one. You remember when we were doing discontinued operation. There, if you see it, it will become easier. Because in most cases, it's just basic EPS. There you will say basic EPS, comma, within brackets, you will have to say income from continuing operations. Then basic EPS, net income, like that. Is this clear, Vishnu?
Yes, ma'am.
Yeah, I'll try to call out a balance sheet which has discontinued operation. Then it will become easier for us. Okay? Because I think even in Tesla, this is the balance sheet is just the one which has income from continuing operations. Yeah, this one. See, this is Tesla. Again, here you have only one because there is no discontinued operations here. You're showing the net income and then see, can you see this? This is net income per share of common stock. Now, there you will say continuing operations per share of common stock, and then you will show it. And then when you show discontinued, you show it, and then you will show net income, and again you will show this figure. So 3 times this figure will come. Is that clear? I think I showed you a balance sheet for this. I'll just take that out. Then I'll show it to you. There was one. Just go in my elements. There will be a balance sheet that I had uploaded for the discontinued operation. Just check it there. You will find your answer. Okay. Now let's go to VANOS. How do you calculate the weighted average number of shares? Again, the logic is very clear. I am taking the net income, which is a period figure. So I'm taking the denominator also, and I'm making an average out of it. Okay. So what is the question asking you? The question is telling you that assume the following common stock transactions during the year. We have Jan 1, there was a beginning balance of shares of 240. On March 1, we had 60,000 shares. On August 1, I bought back 20,000 shares. And on November 1, I issued fresh 80,000 shares. You're supposed to calculate the VANOS, and then you're supposed to calculate the basic EPS, taking the net income figures from the earlier example that we just finished. Is that clear? Okay. A first approach is approach that I generally follow. Okay, I call it the cumulative approach. There are 2 ways by which I can calculate VANOS. Somehow I'm more comfortable with the second one, which is the cumulative approach. If you're more comfortable with the first one, which is just the individual approach, you can do that also. So I'm first following something called a cumulative approach to calculation of VANOS. So how are we doing it? See, if I look at the dates, what are the dates that are given to me? I have a Jan 1. On Jan 1, what was the thing? I had a beginning balance. Beginning balance for how many shares? For 240,000 shares. And they were outstanding for what period? They were outstanding. So at any point of time between Jan, Feb, 2 months, I had full 240,000 shares outstanding. Yes or no, guys? 2 out of 10. Because in March 1, so I'm taking a cumulative approach, right? So for 2 months, Jan and Feb, the number of shares outstanding was $240,000. Okay. So if I take the weighted average of these, I will take 240,000 for 2 divided by 12. It's going to give me a figure that will correspond to 240 for 2 months. Because for 2 months, the number of shares outstanding was only 240. Yes or no, guys? It is 1,640,000 shares. Then, March 1, I came up with a fresh issue. So, what was a fresh issue? The fresh issue was for 60,000 shares. So, total shares outstanding was how much? Now that 240 was added with 60, and now I had 300 shares, 300,000 shares outstanding for how many periods? March, April, May, June, July, 5 months. Have you understood this? March to July. This is Jan and Feb. So I'm taking a cumulative approach. For the next 5 months, March, April, May, June, and July, I had 300,000 shares which was outstanding. So if I take the weighted average, it became $300,000 into 5 by 12, which is $1,25,000. Is this making sense, guys? Everybody? I'm taking a cumulative approach. So now on August 1, what I did, on August 1, I bought back how many? 20,000 shares. That means for how many months now? August, September, October. For 3 months, which is August, September, and October, I have how many shares outstanding? So this plus 60K, this minus 20K will give you $280,000. This was outstanding for 3 months, August, September, and October. So we have 280,000 shares outstanding for 3 months of the year, which is 7. I'm not checking your calculation again, then I'll look, okay? Which is 70,000 shares. Now, on November 1, what am I doing? On November 1, I am further issuing 80,000 shares. 80,000 shares. That means if I add 80K here, I will get 360,000 shares valid for 2 months, which is November and December. So this will become 360 for 2 out of 12 months, which is just add up all these shares. How much is it? So my weighted average number of shares becomes how much? 295. Is that clear, guys? So this is one approach, okay? There is another approach which is equally correct if you want to follow it, which is take each issue separately, okay? So what will happen if you take each issue separately? Then you will have to take 2,40,000 for the full year. Is this clear or not? So I'm just taking a shortcut and I'm writing it here. I will take 2,40,000 for full year, which is 12 months. Then I issued 60,000 shares on March 1. So basically for 10 months. So $60,000 for 10 months, it is outstanding. That means I'm taking each individual event separately. Then I bought back 20,000 shares. That means this 20,000 will be a minus in the month of August. August, September, October, November, December. 5 months. And then again I reissued 80,000 shares in November. So 80,000 into 2 divided by 12. November and December. Just calculate it. This should also give you $295,000. Is this clear to everybody? So in the numerator, we can have only the complications on account of cumulative preferred dividends, and you take it. If it is cumulative, you just take it for 1 month, whether you've declared, paid or not immaterial. If it is non-cumulative, you only see whether it is declared or not. Whatever is the declared amount, you reduce it from your net income to arrive at profit. For your denominator, you take all the things, and now since they are outstanding for different number of months, we have to bring it to a common average. On an average, how many shares were outstanding throughout the year? That becomes my weighted average number of shares, and now that figure becomes comparable with my net income figure. What is this, guys? Is this adding up? Is it coming to 295? Did you just check it up? This should add up, okay? To 295. So either of the two approaches you can follow. Okay? Yeah. I'm layering it up, and this is not easy, but if you can understand what we're doing here, then this is the most complicated that it can ever get, guys. Okay, so if you understand this concept that we're going to do for stock split and stock dividends, then you can handle any questions from this area. Okay, So what happens when there is a stock split? Can I assume that the earlier one was clear? Can we move ahead? Everybody? Okay. Now, what they tell you is, in case if there is a stock dividend or if there is a stock split, that means something which has an impact on the values. Always assume that it happened on the first day. Okay, so always assume that stock split or stock dividend happened on the first day of the year. That means in the beginning of the year, this thing has happened. The problem happens when there is an issue or a buyback subsequent to this. Then what do you do? So see, or later, so we'll see how it works out. Okay. Same example that we had above, but now you're assuming that there was a 50% common stock dividend on June 1. That means somewhere here, June 1, we declared a 50% stock dividend. And then they are saying that there was also a 2-for-1 common stock split that happened on October 1. And somewhere here on October 1, we had a common stock split, 2-for-1. Now, first of all, tell me if my total values was 100 and if I'm having a common stock dividend of 50%, what will it become? What will 100 become if there's a common stock dividend of 150, guys? Sorry, of 50%, 100 will become 150, isn't it? That means I'll multiply it by 1.5. Is this clear to everybody? If I'm giving you a bonus share of how much, whatever number of shares you're owning, I'm giving you 50%. Half of that I'm giving to you. That means after the stock dividend, I will simply take the pre-dividend figure, multiply it by 1.5. I will get the post-stock dividend figure. Yes, no. Everybody clear with this concept till now? And then when there is a 2-for-1 common stock split, 2-for-1, what will be the ratio? Tell me, guys, quickly. If it is 2-for-1, okay? 2-for-1. What will be the ratio? How will I do it? 2, that means 1 became 2, right? I will simply multiply it by 2. Do you understand this? 2-for-1. That means for 1, I made it 2. By what? By giving you a stock split. So 1 stock became 2. So what is the total number of stock post the dividend? It became into 2. Vishnu, is this clear? Not 2 plus 1. 1 became 2. Vishnu, is this clear? This is a stock split. Vishnu, is this clear? It is not 3. 1 did not become 3. 1 became 2. So you just doubled it. Is this clear? So how are you going to work this out now? Okay. So we'll start with date. Date is important. So the first event happened. Okay, yes. So the first event happened on Jan 1. Okay. What was the event? The transaction that happened was it's just a simple beginning balance. Okay. What was the common stock which was outstanding? Common stock outstanding was $240,000. Is this clear, guys? Everybody. Common stock outstanding was $240,000. Okay. Now we said that whenever a stock split or a stock dividend happens, you're going to assume it happened on the first day of the year. So what was? So let's take we restate the stock for the stock dividend. Okay. And then we restate it for the stock split. Okay. And then we need to know for what portion of the year it is outstanding. If we know the portion of the year, we can easily calculate the weighted average. Is this clear? So what we will do for this, I multiply it by 1.5. Yes. and then I will multiply it by 2. And it is outstanding. Now I know which period it was. It was only for Jan and Feb. That means for 2 months. That means 2 divided by 12. What is the figure that you get here? I started with a stock of 240. It became 1.5. And then it also became 7.2. Yes or no? And that is applicable only for 2 months of the year. So this became $1,20,000. Is this clear to everybody? Any questions, guys? Anybody? Any question? Clear? Now see what happened. The next thing was March 1. What happened on March 1? On March 1, we had issue, fresh issue was there. How many did we reissue? We issued 60K. Yes or no? So now we have how many outstanding? Now we became $300,000. So if I look at, I will assume that these were also split and restated for the entire year, because we are going to assume that this happened in the beginning of the year, isn't it? So what will I do? I'll multiply it by 1.5, then I further multiply it by 2, and I know that it was outstanding for 5 months of the year, right? Because it was March. So March till, what was the next event? March till June, because in June, March till August. So March, April, May, June, July, 5 months, right? March till July. That we did in the earlier example, if you see, right? For 5 months now, I had, instead of 300, now these stocks have become something else, right? Because this 300 is now equivalent to how many? The 300 is now equivalent to 300 into 1.5 into 2, and now it is outstanding for 5 months of the year. So it is 375. Yes. Is this clear, guys? Everybody? So see, when you have a cumulative approach, now you don't have to bother about anything else. You just have to continue doing what you're doing. Now what happened on June 1, I now distributed. Do you see this? This is the event that happened on June 1. So I distributed what? I distributed stock dividend. How many stock dividends did I distribute? Now this, do you realize this now is becoming 1.5. So my total outstanding shares now becomes $450,000. Do you understand this? No impact here because we've already given the impact in the weighted average. But when I take the totals, it is no longer 300. The total has now become 450 because there is a stock split that has actually happened in real time. So this has become 450. Is this clear? Then the next event, what happened? On August 1, I had repurchased 20,000 shares. Now, do you realize, guys, that when I repurchase, how many? I repurchased 20,000 shares. That means this will become 430,000 shares. Yes or no? For which there will be no stock split that will happen because that has already happened earlier. For which only the new thing that will happen is the stock dividend. And this will be applicable for 3 months of the year. August, September, October. Because November, again, a new event is coming up. How much is this becoming? So this is 430,000 into 2 into 3 divided by 12 is becoming 215,000 shares. Have you understood why we are not multiplying this repurchase again by 1.5? Why? Because it has happened earlier. The repurchase happened after the stock split. So you cannot again multiply it by 1.5. Is this clear to everybody? Now what we are doing? Now we're coming October 1. On October 1, what is happening? The stock split is happening. So there is a stock split happening. What is the stock split happening? On the stock split basis, these number of shares will become $860,000, 60,000 shares. No impact on the number of shares and everything else. Then on what happened on November 1, I issued fresh issue. How many? I feel 80,000 shares. Yes or no, guys? Everybody. So if I add 80K to this, now it becomes 940,000 shares. Yes or no, guys? Everybody. So this became 940,000 shares. This, sorry, this has already happened earlier, right? So I will simply take into 2 divided by 12. How much is it, guys? 940,000 into 2 divided by 12. 156,667. So what is the weighted average number of shares? Just tell me the figure. Plus 215,000 plus 375,000 plus 120. 866,667.